Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly record purchase transactions under the perpetual system. So if you're unfamiliar to recording inventory under the perpetual system, don't fret gang, I dropped a link to get you up to speed in no time. So with that being said, let's rock and roll. So it tells us that consider the following transactions for toys and more. So we're going to click on this. And we have a couple of transactions for the month of May. Then it tells us to journalize the purchase transactions. And it tells us in the final analysis how much did the inventory cost. Alright, cool. So gang, we are dealing with inventory. And as we already know, there's a purchasing side and a selling side of inventory that you must know how to account for. In this particular problem, we're dealing with the purchase side. We are also utilizing the perpetual system, which dictates that we adjust our inventory after every purchase and sale directly. So with that being said, let's get into this problem. So on May 8th, Toys and More purchased $113,300 worth of Mega Block toys on account, credit terms, 210, net 60. Okay, so a couple of keywords was that we purchased on the account and we have some discount terms of 210 net 60. So let's elaborate on these discount terms first for a bit, gang. Basically, this is telling us as the company that we will receive a 2% discount if we pay within 10 days from May 8th, or we have to pay the remaining or entire amount within 60 days from May 8th. And so right now we're just recording the purchase on account. And so with that being said, we know how to record that gain. We're going to directly increase our inventory through a debit for the $113,300. And we are going to credit accounts payable. We're going to check the answer. Fantastic, gang. Moving on. On May 12th, it told us that Toys and More returned $11,250 of the merchandise to Mega Block due to damage during shipment. Alright gang, so we returned some goods. Here's the deal, couple of rules I want you to remember. Inventory is always on the books at cost. So what do I mean about that, gang? Anytime you see the value of inventory, whether it's on the balance sheet or whether it's on the ledger, it solely reflects how much the particular inventory costs the company. And so this example for May 12th, we're returning the inventory. So you must always ask yourself when you're on the purchasing side of inventory, how does this transaction affect the cost of inventory? Obviously, when we return inventory back to the suppliers, the cost of our inventory must go down, which means that we have to adjust directly our inventory account. We need to decrease it, gang. Since we originally purchased it on account before, our liability must be decreased as well. Therefore, we're going to debit accounts payable and we're going to credit inventory, gang, for the $11,250. We're going to check that answer. Well done. Moving on. On May 5th, it tells us that Toys and More paid the amount due, less returning the discount. So here's the deal, gang. When dealing with inventory, you always pay attention to the dates. The dates are critical to let you know whether or not you're going to receive or give a discount. So following back to May 8th, we know we had a discount initially, which stated that we would get a 2% discount if we paid within 10 days of May 8th. Fast forwarding to May 15th, we are now making a payment. We want to pay it in full, but an event happened before that, gang. We made a return of $11,250. So our initial amount of inventory has to get adjusted by the $11,250 to know what the total amount that we have to pay. If we subtract the $11,250 from the $113,300, we should get $102,050. That's going to be the amount that we're going to pay. But remember, gang, we paid within the discount terms. We paid within 10 days of May 8th. So we're technically not going to pay the cash amount of that $102,050. we're going to pay the cash amount of $102,050 minus a 2% discount. So, first things first, we need to remove accounts payable off the books at the gross amount, the initial amount. So we're going to debit accounts payable for the gross amount of $102,050. Once we do that, we're going to credit the cash in which we have to make the payment for. We already know, gang, that our calculation for the cash amount within a discount term will equal $102,050 minus 2%, or $102,050 times 0.98. Either way, that's going to get you the same exact answer, and we know that to be $100,009. Now, clearly we know, gang, we're not finished with the journal entry because our debits and credits aren't equal yet. But remember what the key rule that I told you just a few seconds ago.
I remember.
Inventory is always on the books at cost. So what does that mean? You tell me, gang. If we receive a discount for paying for our inventory within a time frame, how does that affect the cost of our inventory? Discount should automatically make the cost of the inventory that you bought go down. Therefore, we must directly reduce our inventory account, gang. So we're going to credit inventory for the discounted amount, which happens to be $2,041. We're going to check that answer. Good job, gang. So there you have it. A quick walkthrough process of how to properly account for the purchase side of inventory when you're doing the perpetual system. We looked at a return and we looked at a discount payment within that time frame. So hopefully you learned something and you're just that much closer to chasing the bag with this accounting information. And if so, hit that like button, hit that subscribe button, and share the channel with your friends so they can get it too. As always, gang, I really appreciate the time that you share with me, and I will see y'all soon. Bags!